So let me take this opportunity to greet you. Good morning and welcome to our today's session. And happy new month again. We are doing cost of capital, which is our next topic. And the cost of capital already borrows a lot of knowledge from the previous topics which we have done. And we are saying that this is the minimum required rate of return, the minimum required rate of return by the providers of the long-term funds. For example, we are looking on the providers of equity, preferential capital, and long-term debt stroke debentures. So basically, when we are looking on the cost of capital, we are just looking on the we are just going to be looking on two different bits. One, where we are going just to be checking on the existing capital structure of the organization. Secondly, we shall be able to check on what are the ways in which the organization can be able to raise funds to finance the new projects. Now, when I look on the factor that influence the firm's cost of capital, one, we are going to be discussing about, we're going to be checking on the component costs, and we are saying these are the specific, these are the cost of specific sources of finance or to the company. For example, we have the cost of equity, we have the cost of preference shares, and then we have the cost of the long-term debts. In simple terms, we are just saying that organizations need to be looking, these are the different sources of looking for capital, whereby the organization need to be financed through the three different sources, which you have already indicated there. And already this one normally assists you to understand about what am I supposed to be doing when we are going to be approaching some questions as we move on? Because most of the questions basically, which you are going to be doing, first thing that we have to be doing should be the component cost. That is always the first thing to do. Now, the second thing, because I will be able to share with you, or I will be able to show you how it is normally done. So let us just move on. We are saying the higher the component cost, the more the cost of capital, because we are just looking for costs. And due to technicalities which we might be experiencing as companies, we just need to have the ordinary shareholders who are the owners of the company. Secondly, we just need to also have the preference share. These are the people who want to invest with the company for a certain benefits. Then in case the two options cannot be able to give us money, we normally go to the bank to seek for loans. We shall be able to check on that later. Now, we have the weight stroke proportions of each capital component in the firm's capital structure. We are saying the component with the highest proportions affect the firm's cost of capital more than the other components. And I will be able to show you that. Number three, we are talking about the tax rate, and we are saying companies that operate in environments of higher taxes, like what we are experiencing today, tends to use more debt finance in the capital structure. What is the reason about this? We are saying this is because the interest on debt, being a tax allowable expense, provide the company with some tax savings known as the interest tax shields. Another one, we have the availability of asset to pledge as a security, and we are saying a company that has collaterals, and we know that the collaterals, these are the assets which we can be able to pledge during the time we are assessing funds, for instance, from the financial institutions. We are saying a company that has collaterals may easily use debt finance to finance its operations. Another option, so you can be able to use the quotation at the stock market, and we are saying a company that is listed, for example, whose securities are trading at the security market can easily raise additional funds through the issue of ordinary shares to the public, unless a company that is not, is not listed here. Because the company that is already listed is going to be raising more funds with no struggles whatsoever. So it is easier for them to get some funds because already their shares are still trading in the securities exchange, and then we are going to be receiving some bids for the people who may need to purchase our securities. Now we are saying the firm's component, the firm's cost of capital is a combined cost made up of the component cost, which comprises of the cost of equity, cost of preference shares, the cost of long-term debt. Let's just start by elaborating more about the cost of equity. We are saying it is the minimum rate of return required by the ordinary shareholders, for example, or that is, it is the discount factor that equates the present value of dividends to the current market price per share. So how much because we are looking on what is our discount factor? We are saying two methods available for calculating the cost of equity. We normally use the Gordon's dividend growth model, which was a method for the valuation of the ordinary shares. Then I will be able to introduce to you the capital asset pricing model, which is CAPM. It is normally called CAPM. Let me just put a C there. It's normally called CAPM. Now, when you look on the Gordon's dividend growth model, while we were getting the market value or the intrinsic value, we were saying, to get our PO, we normally take the D1 over KE minus G, but in this case, we just want to make the KE the subject of the formula, so we just need to cross multiply, and you can be able to see very well explanation or computation for my notes there. And you can see to get our cost of equity, we just need to take the expected dividends, if they are the ones which are given in the question. We divide by the market value plus the growth rate. And we are saying in case the shares are issued at a discount, it is going to be reducing the market value. Hence, you can be able to see here the cost of equity of ours. We are going to be getting it by taking D1, that is the expected dividends. You divide by PO minus D plus G. But during the time when we are being given the dividends which have just been paid during the period, we normally take the DO, 1 plus G, divide by PO minus D plus G. These are the computations which I will assist you to know when I will be able to do our illustrations. And we are saying that the equity comprises ordinary share capital, which is always our external equity, and retained earnings, which is our internal equity. And we are saying the cost of equity of each is determined the same way, except that in case of shares issue costs, in case of the shares, let me just get back there, see how that note goes. I have said that, let me check, please. I have said the cost of each capital is determined the same way, except that in case of flotation cost, it should be in case of flotation costs, should be here. The flotation costs, let me just make it clear. In case of a flotation costs, flotation stock issue costs, it should be like that. Such cost will only affect the ordinary shares. The reason as to why we are saying the flotation always affect the ordinary shares is because this share, when you look on the retained earning, this is just a proportion which is agreeable between the ordinary shareholder, that we just want to hold that money within the organization for the reinvestment purposes. So what you need to understand is that the retained earnings are never issued, and therefore, if that is the case, it means the ordinary shares are the ones that are normally issued to the public for subscription, and they are going to be affected by the issue cost. So when you're calculating the cost of equity, when you are using the ordinary shares, we normally take the D1, you divide by PO minus D minus F plus growth rate. When you're given the current dividends, you see what you're supposed to be doing. The elaborations of the explanation of each item is already put down there, and which now I know it is not a new thing to you. I have also given you the ways of two methods which are basically used in the computation of the growth rate, and I already attached them there with a bit of explanation. With those are the things that we learned in our previous topic. Now, we have the capital asset pricing model, which is the second method applicable in the evaluation of in the computation of the cost of equity. And we have said that CAPM incorporates risk in calculating the cost of capital, and we are saying any firm shall always experience two types of risk. One, and already these are examinable, we are saying we normally have unsystematic risk. and systematic risks. When we look at it, we say, and systematic risk affect an individual firm in the industry, depending on the nature of its operations. For example, the risk of losses due to change of weather or poor quality, you can see that is an issue which might be affecting one organization. Not all the organizations which are going to be affected by weather or poor quality of the products, because already each companies are dealing with different types of products, and we are saying the risk can be avoided or eliminated through diversification, hence it is not included in the analysis. Now, we have systematic risk, and we are saying it affects all the firms in the industry, hence it cannot be reduced, stroke avoided, stroke eliminated through diversification. For example, we are talking about inflation risk, and we might also be incorporating things like COVID-19, which affects all the organization. That is also an example of systematic risk. We are saying that it is involved in the analysis, and it is measured using the beta coefficient. And you can see the sign for the beta coefficient. We are saying investors will always demand an extra return on top of the risk-free rate of return to be compensated for this systematic risk. And the reason is why we normally invest. We invest because there is a risk which we have to undertake, and therefore, at the end of the day, we require some returns. That is why we normally invest. So if you can invest without basically understanding the concept of getting back a certain proportion of return, then it means that you might not end up getting any. So using CAPM, cost of equity can be determined using the formula, and we are saying the cost of equity is equal to the risk-free rate of return plus the risk premium. The risk premium is where we normally take the expected return of the market minus the risk-free rate of return. Then we multiply by the beta coefficient, which we have said it is normally used to measure systematic risk. Now, when you look on the cost of irredeemable bonds, which is our second component cost, we have said that when you recall, you will be able to find that you will be able to find that when you are getting the market value for irredeemable bonds, no, it should not be going like that. Let me check. Okay, it should be like this. The second one should be the cost of redeemable bonds. Okay, some of the notes which okay. Now, the second one should be the cost of preference shares, and I've said it is the minimum rate of return required by the preference shareholders. That is the discount factor that equates the present value of the expected preference dividends to current market price per share. You remember when we were getting the market value of the preference shares, we were taking the preference dividends to divide by the cost of the preference shares. But in this case, we want to make the cost of preference shares the subject, and we can just cross multiply, and you can see when we are calculating it, we just need to take the preference dividends to divide by the market values. And in case of the discount, because you know the preference share capital is basically issued to the interested investors, it has to be, it can be able to, the market value can be affected by the discount and flotations. Now, when you look on the another one, we are saying in case shares are issued at par with no discount with no discounts or flotation costs, KP becomes the coupon or preferred dividend rate. We shall be able to look on that as we factor doing some illustrations. Now let's go to the third component cost, which we are saying it is the cost of the long-term debts. And I've said it is the minimum rate of return required by the providers of the long-term debt finance. In calculating the cost of debt, bonds are categorized into two. One, we talk about irredeemable bonds, and then we normally have redeemable bonds. Let me just go back here and look on the analysis of the cost of irredeemable bonds. You remember when you are getting the market value of the redeemable bonds, we just take interest to divide by the cost of debt, and then we multiply by the tax. Because what we are doing up there to make the KD the subject, it is because we just first want to get the before tax cost of debt. And once we get it, because we know these ones might be affected by discounts and flotations when you are computing the cost of debt, then it means that we have to be incorporating taxes, because interest on debt is a tax allowable expense, hence it will provide the company with some tax savings, known as the interest tax shield. And we are saying for this reason, the ideal cost is therefore the after tax cost, hence before tax cost should be adjusted for tax purposes. That is what you can see our notes are doing there. Now, when you look on the cost of redeemable bonds, we are saying these bonds have a maturity period, because irredeemable bonds, they don't have a maturity period. And that is the thing that you're aware of, because I taught you if from the valuation models. And we are saying that their before tax cost can be simply determined using the concept of bond yield to maturity. So to get our YTM, you can see we normally take the interest, you divide by the number of years, but we take into bracket the market value, minus the face value, then you divide by the summation of the two, you divide by 2. Then you attach your adjustment for the tax purposes, and you can see that is what already I have done. Before we do any question, because most of the questions are basically directed to weighted average cost of capital and weighted marginal cost of capital. Let me first introduce to you the weighted average cost of capital, and we are saying it is the combined cost of the existing funds used by the company to undertake existing project. That is, it is the combined of the cost of equity, cost of debt, and the cost of preference shares. And we are looking on when we are going to be looking on the question regarding to the weighted average cost of capital, we are just checking on the existing capital structure of the organization. If the organization is financed by debt and equity, you cannot be able to tell us that, Mwalimu, we normally have some preference shares, which can be used to raise more capital for the organization. No. If it is debt, it depends on how the capital structure of the organization looks like. And that is what we're supposed to be analyzing, not looking on the extra costs needed to finance any project. So what are some of the steps on calculated WSCC? One, we are saying that calculate the component cost, which comprise of the cost of equity, KP and KD. Number 2, we are saying calculate the weighted proportions of each capital component in the firm's capital structure. The market values are used to calculate the weighted for the following reasons. Investors acquire their investment at the market trades, and they will always compare such investment at any point with the market to determine whether there is a gain or loss. 2, assets used in security or as a security, it should be as a security or collateral for raising additional funds through debt are always valued based on the market ends. Such funds should always be evaluated as per the market and not historical book values. Use of the market value is a more realistic way of evaluating it. It should be just off, not double F, but it should be only one of evaluating the financial assets and not the historical book values. That is, the market value shows the true state of affairs. The other one, we are saying that the use of market value is in the line with the main objective of maximizing the true value of the firm, because they are normally associated with the present value of expected future cash flows. Now, as we reach up to that point, I would just like to engage on teaching you much about the computations, because the computations are the one which will assist you to understand more about this kind of topic before we engage on our last bit of the topic, which is the weighted marginal cost of capital. So let me just look on the questions which already are tested under the current topic we are doing. And I will just quickly start with the first one, which was tested from our last exam, last sitting. We are discussing about a question tested in April 2023, question 2B. We can be able to open these questions from your end. And sorry, our brother from another country, because last time we were not able to wake up. Okay, so your colleagues were let down. That is what I can suspect. but we are hoping for the best. Now, let me look for these. Anyone who can share this link? I think I'm missing it. Someone to share the questions link in our WhatsApp or somewhere I can pick it. Someone, please. Okay. Someone to share the link on our chat box in our Zoom so that I can pick it from there. I have to open the question for you because I can't find mine. Okay, I have gotten mine. I hope you have yours. Okay. Okay. We are looking at the financial management questions regarding to WSEC and the computation of okay, we are good now. So let us continue. Sheila, good morning. You can read our question kindly. We're discussing about question 2B. So let us go there. Question 2B. Go on, kindly.
Okay, the following information was extracted from the financial statements of Rainbow Limited for the year ended 31st December 2022. Capital structure in amount: ordinary shares 750,000 shares of 20 shillings each. Amount is 50,000. Retained earnings 48,900. 8% preference shares, 100 shillings per value, 5,000. 10% debentures, amount is 7,500. Additional information: the preference shares were originally sold in 2014 at 104 shillings per share. The current price is 94 shillings, although a similar issue can be made at 89 shillings net. 2. Ordinary shares are currently selling at 38 and 40 cents shillings on the Securities Exchange. The debentures were sold in 2015 and realized 96 shillings per unit. The current price is 80 shillings, and it is anticipated that a similar issue would also sell at 80 shillings per unit. Corporate tax rate is 30%. Last year's dividend amounted to 3 million, which was 70% of the net earnings. The company expects these dividends to grow at a rate of 6% per annum and the dividend payout ratio to remain the same. 5th, new ordinary shares can be sold at 40 shillings, but in order to guarantee success, they would have to be sold at 35 shillings per share. Required: cost of preference shares, 2, cost of ordinary shares, 3, cost of debentures, then 4, market weighted average cost of capital of the firm.
Thank you so much. You can see how the examiner is able to put the question there. And one of the key things is that the additional information is always the elaboration of the existing capital structure of the organization. And we can already see the examiner is telling us when we start with the preference share capital, he is telling you that the shares were originally sold at 104 per share in 2014. So the current price is 94, although a similar issue can be made at 89 net. What does that mean? That is where the students got confused in this exam. Because the 89 net, it means that they have already deducted for you any discount and flotations. The same applies to the ordinary share. They are saying the ordinary shares are currently selling at 38.40 on the securities exchange. But when you look on note number 5, we are being told the new ordinary shares can be sold at 40. But in order to guarantee success, they would have to be sold at 35 shillings per share. So you will see they have already given some discounts there. So they are selling at 35, and that is what you're supposed to be checking on. We shall be able to factor that. And we can see when we look on the debentures, and the most important we have to be checking are our debentures. Our debentures redeemable or irredeemable, and we are saying the debentures were sold in 2014 and realized 96 shillings per unit. The current price is 80 shillings, and it is anticipated that a similar issue would also be sold at 80 shillings per unit. And then we have our corporation tax rate given in that regard. Now, we already know that the formula applicable here will be for irredeemable bonds. So let me just go to the board and show you how these computations are basically done. When you look at it, is that when you're doing any question, whether you're calculating the WSCC or WMCC, the first thing that you're supposed to be doing is the computation of the cost components. Always calculate the cost component first. And I will be able to start with number 1. Let me start with the cost of ordinary shares. The cost of ordinary shares. We are talking about the KE. Now, from our notes, we have said we can go the cost of equity by taking DO 1 plus G, you divide by PO minus D minus F, if we are doing for ordinary shares, right? Plus our growth rate. When I look on the question provided there, when I look on my question, I will be able to find, that when I look on the question on part of the ordinary shares, we have been told last year's dividend amounted to 3 million, which was 70% of the net earnings. And we have been told that the company expects the dividend to grow at a rate of 6 shillings, 6% per annum, and the dividend payout ratio to remain the same. So the first thing that I'm supposed to be looking at it there is the computation of my DPS, which I'm supposed to be taking the total dividends. We divide by the number of ordinary shares, the number of ordinary shares. So in this case, it means the total dividends of mine is 3 million. And when I look on the existing capital structure given in the question, I can be able to see that we have 750,000 shares. So how much is our DPS? How much is our DPS there? Just take 3 million. Let me just take 3 million. 3 million. You divide by 750,000, getting Kenya shillings 4 per share. So to get our cost of equity, we are going to be taking 4, 1 plus 0.06, because the growth rate of ours is 6%, as per the note number 4. Then we divide by what is the market value of ours, which we can be able to use. We are going to be using on the amount which we can be able to sell. And we can see we have been told they would have to be sold at that 5 shillings per share. That is what the one that we are going to be using. So how much is this? How much is this plus the growth rate here, plus 0.06? How much is the cost of equity? So it will be 1.06 times 4 divided by 35 plus 0.06. We are getting around 18%. We are getting around 18%. Let me just use the whole number, 18%. That is how you compute it. Number 2, we are looking on the cost of preference shares, which is, we are calling it KP. And we have said to get our KP, right, you need to take the preference dividends, you divide it by the market value minus discount minus flotation, right? Then you can just be able to tell me, Mwalimu, let me multiply by 100%, which is obvious. Now, to get the preference dividends, let us check on the percentage, the interest rate for the preference shares, which is given as 8%, times the par value of this security, which is 100 shillings. I'm just copying this from the existing capital structure up there. Then you divide by how much are they trading now? We have been told the preference shares were originally sold at 104. The current price is 94, of which they can be able to be sold at 89, which is net. They have already deducted all that. Then you multiply by 100%. So how much are we getting here? I can just see 8 divided by 89. I should be getting around 8.99%. 8.99%. I think that is also what you're getting from your end. Number 3, we can look on the cost of long-term debt, which is KD. And when you look on our question, we said we have 2 formulas to follow. One of the key formula we said, let's look on the irredeemable, because our question does not have the number of years, it doesn't maturity period. So it means to get our KD, we just need to take our interest. We just need to take interest. We take our interests. We divide it by the market value minus discount minus flotation, and we said this requires to be adjusted for tax purposes. Now, how much is our interest as per the question provided there? Let me see. We have been told that debentures were sold in 2015 and realized 96 shillings per unit. But already we have been told there that the current price is 80 and it is anticipated a similar issue would also be sold at 80 per unit. They are being given the corporation tax rate there. So in that case, we just need to look on the interest rate, which is 10%. 10%, it should be 10% of what? It should be 10% of 96, which you can be able to see is our historical costs, right? Or historical price, sorry. The market value right now, we can be able to see is 80, right? It is 80, correct? Then we adjust for tax, 1 minus 0.3. Now, this tends to be how much? It will be 9.6. You divide by it by 80. Then you multiply by 0.7. We are getting around 8.4%. 8.4%. 8.4%. That is the first stage for the computation of the WSCC. Once we finish it, I just want now to calculate the WSCC. And we normally have our format here. We have the source. We're able to wrap some part here. So we have our source. Then we have our amount. Correct. Then we have our weight, which you're supposed to be calculating. We have our costs, weight cost, and then we take weight times cost. Weight times cost there. We have the source, we have the amounts, we have the weight costs, we have the weight times the cost. Remember the cost of hours are the ones which we have already computed. Those are the component costs, which are supposed just to be copying here as we do our computations. The weights we are going to be calculating, the weights we have to calculate. Now, when I look on the existing capital structure of the organization, we just need to check on, I start with equity. Let me start with equity here. So when I look on the equity, the first thing that we have to be understanding is that these amounts we are talking here should be valued at the market prices. At the market prices. So once I understand that, it means when I'm computing my equity in this regard, we are going to be having, I'm talking of capturing the, taking the number of shares first, because our number of shares we can see in that question given, it is 750,000. We multiply with the current market price, and I can see we were able to multiply it with how much? the current market price of those securities, which we are saying, they are currently trading at 38. Let me check here. What is the market value? So we are discussing about that 5. So it will be 750,000 times 35, getting 250,000. 250,000. That is our equity. Remember, there is a notion where there is already a question in your at the back of your mind where the students might be asking, Mwalimu, why are you not incorporating the retained earnings? Because they are not issued for the public for subscription. So in this case, they are not much needed here when you are computing. Here we just factor the ordinary shares alone. Now, let me look on the 8% preference shares. 8% preference shares. And our 8% preference shares, we are just going to be looking on the, how many preference shares do we have? I say there is no any problem because I can take 5 million, which is the total value. I divide by the par value, which is 100, right? I divide by the par value, which is 100. Then I multiply by the market value of this security, which is 89 bob. So how much is this? I can see 50,000 from my end. So 50,000 times 89, we are getting 4450. 4450,000. We're getting 4450,000. Then the next one we are discussing about the 10%, the 10% debentures. So this 10% debenture, what are we going to be doing with it? The 10% debenture, it should be how much? We have been told the 10% debenture should be, we are taking 7,500, which is the 7.5 million. You divide it by 7.5 million, we divide it by, let me check there. The debentures of ours, we divide by 96. We divide by 96, we multiply by 80. The 96 was the original price of these debentures, and 80 is the current market value. So 7.5 divided by 96, we multiply by 80, we are getting 6250,000. That is an answer which I just want to confirm. Is this our answer correct? Let me check again. 9.6 divided by 80 should be, I think it should be 12%. 12%, we multiply by 0.7. Okay, it is okay. Now let us get our total here. So it means I just need to take 6250 plus 4450 plus 26,250, getting around 36,950. So how are we going to be computing our weights? And I say, in the computation of the weight is very simple. I just need to take 26,250 divided by the total. So that is what I just need to do. 26,250, I divide by my total here. This one should be 0.71, right? Then we have 4450 divided by 36,950. I'm getting around 0.12. Then the last one should be 6250. You divide it by 36,950, getting around 0.17. This one also should be totaling to 1. That one should be totaling to 1. When you take 0.71 plus 0.12 plus 0.17, we should be getting 1 because already it is a probability. Now, from the weights we go to the cost, I just copy the way they are. The first one is 18. I don't want to convert them to decimals. The second one, I got 8.99. Then the third one, this one, should be around 8.4. Then I multiply the weights and cost to get on the far end. So 0.71 times 18, we have 12.78. 12.78. The other one we have 0.12 times 8.99, and we are getting around 1.08. And the last one would be 0.17 times 8.4, getting around 1.43. So how much is our WACC here? How much is our WACC? 12.78 plus 1.08 plus 1.43, getting around 15.29%. 15.29%. 15.29%. That is how you compute WACC. For much understanding, let me just look on another question. There is another question tested there. We have a question in April 2022. April 2022. I know that you are continuing writing. Once you complete writing, just type there complete or done, so that we can move on. Once you are done, kindly update. Kindly do so if we are still together. Let us save time, please. I can see a million done, Shayla done. What about the rest? Complete, Rama, very good. What about the other one? Shayla. Okay. I hope you're okay. Now let's move. I just do an assumption that we are all done. Let's go to April 2022. And Yasmin should be reading for us. April 2022, question 3C. Go on. Someone to read, please. Nobody who can read for us. Rama.
The following financial information related to Panda Limited. Statement of financial position extracted as at 31st December 2021. Equity, ordinary share, 16,005 shilling per value. Reserve, 72,088,000. Long-term liability, 4% of preference share, 12,010 shilling per value. 7%, 6 years redeemable bond, 12,000. Long-term bank loan, 4,000 and 8,000. Additional information: the ordinary share of Panda Limited have an ex-dividend market value of 47 shilling per share and an ordinary dividend of shilling 3.63 per share has just been paid. Historical dividend payments have been as follows. Have year 20 dividend per share 3.09 2018 and 3.22 2019, 3.63 2020 and 3.50 2021. The preferred share of Panda Limited are not redeemable and have a next dividend market value of 4 shilling per share. The 7% bond are redeemable at 5% premium to their nominal value of 100 shilling per bond and have an next interest market value of 104.5 shilling per bond. The bank loan has a variable interest rate that has an average 4% per year in the recent year, and the component tax rate applicable to Panda Limited is 5% per year. Required, the market value weighted average cost of capital of Panda Limited.
Thank you so much. When you look on this question, when Yasmin Rama was reading, sorry, it means that it does not have a growth rate. And that is why they have already given you the note number 1. I just want to elaborate much about it. I can see that the examiner has given you ex-dividend market value, and the ex-dividend market value, it means the dividends which you are going to be issuing or which have been issued are not inclusive in those dividend market value provided. There is another term which the examiner normally use, cum dividends. And when you talk about the cum dividends, it means that the market value given already includes the dividends which are already which should be issued or have already been issued for that specific period. So what am I supposed to do to get my DPS? It means to get my market value, it means I'm supposed to be taking the cum dividends minus the dividend issued. That is the knowledge you're supposed to have. Then number 2, we can see that if the growth rate is not given, what kind of a formula are we going to be using in this kind of a question? It means that to get our growth rate, we're going to be using the root formula to get our growth rate, because that is the kind of information provided. Then after that, we will be able to compute our weighted average cost of capital after we do the component cost. So let's just start by looking on our, what is our cost of, what is our growth rate? And I've said, to get my growth rate in that question, you can take n minus 1, you divide it by, we talk about most current dividends, we divide it by most past dividends, right? You take all of these, you subtract 1 there. When I look on the number of years, because n is the number of years, when I look on that question, the number of years which have been given, right, I can see we have only 4 years. So I will be able to take 4 minus 1, right, the root of, when I look on the table, which is down there, I'll be able to see on the current period in 2021, we have been given 3.50, you divide it by 3.09. 3.09, right? Then once we get all of these, we subtract 1. So in this case, it means this already is 3, right? That is 3. So how much is this? That is your first stage. How much is that? I just need to take 3.50. I divide by 3.09. What I'm getting is 1.13. So I will be able to take 3. Then I press shift. I said you press shift. And then we have a button from your calculator, which looks like that. So shift, that button, we are going to now to be having, you press 3, which is the whole number. Then shift, we're going to be having something looking like this. Then we put our answer, which is around 1.132, right? Then after later on, we subtract 1. Let me just do it. So 3, then I press shift, this button of mine, right? Then I put my answer, 1.132. I will be able to get something closer to 1.042 minus 1, which is equal to 4.2%. 4.2%. Now, when you look at it, when this question is being provided, also confuses the students, I will be able to tell you that there are other students who would want to use 3.63 as provided in the question, and I will say there is no any problem. If you use 3.63, don't subtract this 4 minus 1 here. I have said, if you want to use 3.63, because already I can see there are some of the dividends which have already been paid. Now we have 3.63. Let me just try with you. We divide it by 3.09. Then I take 4, the whole number without subtracting. It will be 4, shift, my button there, right? I put my answer, then I subtract 1. The differences between the two will always 0.1, which will not be having any effect in your computations. We're just going to be getting 4.1%. You can see that will not be able to bring any problem with you. So when we want to use the 3.63 as per our problem, our question here, then don't subtract 4 minus 1. But the best way is to understand this concept. This one will never take you to the wrong places. Now, let's start with the
Question,
component
Madam.
cost. Yes.
So what the difference between this is 3.63 and this most current dividend? What the difference?
The difference is that these are already which have just been paid now. But when we were doing our computation, you can see that the dividends in our historical computations, the 3.50, those are the projections which we were expecting to receive during the current period. And due to the inflation and so on, for instance, when we are looking on dealing with the financial institutions, you'll be able to understand that for the period, they normally project how much are we going to be giving out as dividends. That is 3.50. Then the other one, you can see that now in the actual, because that is what they were able to issue due to the growth for the companies. So in this case, the 3.603 now, we are going to be incorporating it somewhere when we are computing our component costs. So let me just do it here. We start with the cost of equity. We do the cost of equity here. So to get our cost of equity, we are going to be taking DO 1 plus G. You divide it by, you're dividing with what? Let us divide with we divide with the market value, because we don't have the discounts and flotation. Then we add your growth rates. So our DO now here will be 3.63, which they have already issued, right? 1 plus our growth rate, which is 0.042, correct? Then our market value might be provided in the additional information, which we are being given as X dividends of 47. Then we add 0.042. How much are you getting here? Right? It will be 1.042 times 3.63 divided by 47. Then we add 0.042, getting something equivalent to 12.24%. 12.25. It should be around 25%. We can round up there. 12.25%. Now, let us also look on the second one. The second one is the cost of preference shares. And we have said to get our KP, we need to take the preferred dividends. We divide by the market values. Divide by the market value, we don't have the discounts and flotations. So when I look on the additional two, we have been told the preference shares of Panda Limited are not redeemable and have an X dividend market value of 4 per share. 4 per share. So how much is what am I supposed to be doing there? I'm supposed to be going back to the historical or the existing capital structure of this organization, and I will be able to find the long-term liabilities. We have 4% preference at 10. So in this case, it will be 4% of 10. You divide it by our market value. We are being told is how much? 4 shillings, correct? It will be 4. Then you multiply by 100%. So how much are we getting here? So 0.4, that is what we are getting here. You divide by 4. Then once you multiply by 100%, you're going to be getting 10%. You get 10% there. Then we look on the long terms. We have 2 in this case. 1, we have 6-year redeemable bonds. So number 3 here, we are supposed to be factoring the redeemable bonds, and it means they have the maturity periods. So to get our KD here, we have said you take the interest plus 1 over n, right? 1 over n. We take as per our formula, we said you take the market value minus face value. We divide it by a half of the market value plus face value. Then we adjust here for tax. Now, our interest is how much? I will say, to get our interest here, it will be the interest will be 7%. 7%, we can see we are being told the 7% bonds are redeemable at 5% premium to their nominal value of 100. So it will be 7% of 100, right? Plus 1/6, because we have been given 6 years in the question, correct? Then we have the market value of ours. How much is the market value? We have been told have an X interest market value of 1.4, 104.5 minus, right? How much is the, we have been told that we have been told how much the bonds are redeemable at 105% premium, so to their nominal value. So what is our face value now? It means that our face value is 105. Where is 105 coming from? Because the premium is the price above the nominal, the original price. It will be 105% of 100. That is what the examiners told you there. 105% of 100, getting 105. Then we divide it by a half of 104.5 plus 105. Then here we multiply by 1 minus 0.3, 1.0.3. So let us break it down here. We start from the 7. This, I think the first one will be 7 plus, let me just check on this, 104.5, right, minus 105 divided by 6. Right, so we should be getting something closer to negative 0.08. We divide it by, right, we have 104.5 plus 105 divided by 2, getting 104.75. Then we multiply by 0.7. What is our answer here? What is our answer there? What is our answer? It will be 7 minus 0.08. We are getting something closer to 6.92. We divide by 104.75. Then we multiply by 0.7. 0.7, getting something closer to 4.62. 4.62%. 4.62%. Now, once you calculate that, we also need to calculate for the bank loan, because it's also part of that, the bank loan. What are the examiner told you about the bank loan in the additional, the second last? We have been told the bank loan has a variable interest rate at an average of 4% per year in the recent years. We said, when, for example, a security has not been valued at a market value, there is no market value which is affected by the discounts and the flotations, then the interest becomes the coupon rate. And in this case, it means the 4% we just need to adjust it for tax, because it does not have the market value. So it will be 4 times 0.7, getting 2.8%. 2.8%. 2.8%. Do you have any question up to that point? 2.8%. Any questions so far? I think we should not be having any. There is a bit of understanding here. So in this case, we start with the sources. Source, we have amount, we have weight, we have costs. Then we take weight times costs. We start with our equity. And in this case, we are not given the market value. We are not given the market value. So, we are not given the number of shares, but that is not a problem, because we can be able to calculate by taking 16 million. You divide by the par value of 5 shillings from the chart which you have been given there. Then you multiply by how much are these security trading on the markets. I'll be able to find they are trading at 47 shillings. So I multiply by 47. So what is the amount? 16 divided by 5 times 47. We should be getting 150, 400,000. 150, 400,000 there. Now the other one will be the preference shares. So we're going to be working with the preference shares. I can see we have been given a 12 million You divide by the par value of this security, which is 10, correct? Then you multiply by the market value. They are trading at how much? I can even check here. They are trading at 4 shillings now. So it will be 1.2 times 4, getting 4.8 million. 4.8 million there. Then we have redeemable bonds, 7% redeemable. The 7% redeemable, do we know how many bonds do we have? We say no. But in this case, I can just take 12 million. The par value of these redeemable bonds, we are being given in note number what? Note number 3, which we are being given is 100. Then we multiply by our market value, which is 104.5. The market value of 104.5. So 12 million divided by 100 times 104.5, we are getting 12,540. 12,540. What is our total here? Right? What is our total? Is our total? Oh, sorry, I have forgotten the bank loan. Sorry. We have the bank loan, which has not been, it does not have any valuation, and therefore we're just going to be using the one given in the question. So the long-term bank loan, it will remain at 4 million. It has not been growing over the past years. So what is the total now? We can get our total in that case. So it will be 4 million plus 12,540,000 plus 4,800,000 plus 400,000. We are getting 171 here. 740,000. So let us compute our weights. We take 150, 400, divide by 171, 740, 0.88. The other one will be 4,800 divided by 171, 740, getting around 0.03. Okay. 12,540 divided by 171, 740, getting 0.07. Then the last one will be 4,000 divided by 171, 740, getting around 0.02. Let us check on whether we can be able to total to 1. So 0.88 plus 0.03 plus 0.07 plus 0.02, we are getting 1, correct? We are getting 1. Then from there, just copy my costs, component cost. So now I was able to compute from the cost of equity, 12.25. 12.25. The cost of the preference shares are 10. We have the redeemable bonds, 4.62. Then the last one should be 2.8%. 2.8. So let me just start by multiplying 0.88 times 12.25, getting 10.78. This should be 0.3. 0.07 times 4.62, getting 0.32. Then we have 0.02 times 2.8, getting 0.06. So how much is this? 0.06 plus 0.32 plus 0.3 plus 10.78. And our WACC will be 11.46%. 11.46%. 11.46%. That is the kind of computation which you are required to do. As you compute and understand your question. Now we have a similar question to this, and that similar question, and which I just want to test you on how you can be able to compute I'll give you an assignment of a similar question in May 2018, question 3B. May 2018, question number 3B. Right. Remember, this is an area which is mostly preferred by the examiner. We have another problem, and I will also want to see your understanding from our previous topics which we have encountered. We have May 2017, question 1B, and most of you, they don't give these assignments, but the exam will push you to do them. We have also another question with the same concept as the one we have done. November 2016, question 2B. November 2016, question 2B. We also have another question in May 2016, question 2A. May 2016, question 2A. We have a lot of computations for this. We have November 2015, question 2B. November 2015, question 2B. We also have another question which was tested on August 2022, question 1C. August 2022, question number 1. It should be 1C, sorry. It should be 1C. We also have a similar question tested on May 2021. May 2021, we have question there, question 3B. Let me give the last one now, because you have to understand it is a very area which is mostly tested. We have November 2018. It should be 2019 rather. November 2019, question 3C. Then the last one. We give the last one now. We have May 2019. What is happening with 2019? 2019, May 2019. We have question 3A. May 2019, question 3A. I have given you how many questions? 1, 2, 3, 4, 5, 6, 7, 8, 9 questions for practice for the computational WSEC. The next time, which is on Tuesday, we are going to be concluding the topic by learning much about the weighted marginal cost of capital, and then we do leverages as we conclude on the topic. So let us keep on doing these illustrations and computations as we engage on our next, because I think on next Saturday we are supposed to be starting ratio analysis, which is also another area which doesn't miss. You could be able to see on your previous past papers on how the examiner factors the ratio analysis. Then later on, I think next week, somewhere over the weekend, we should be doing what? Not this one, the first week, the second week of July, we're supposed to be starting the capital budgeting. An area also is a black spot to the examiners. So those are the things that I just want to leave you with it today. Just think about it. Let me wish you a good day and thank you for your response. I'm proposing that every time we have early morning classes, please let us be on time. Let us keep time because early morning is always a very short period because we are managing the class and also going to work. So let us not miss that concept. So let us just work on time. Let us join the classes on time to avoid having any inconveniences. So let me stop at that point. Wish you a good day. See you next week. Thank you and bye-bye.